Okay, so chapter 11, stockholders' equity. Now, we will do chapter 11, 13, but 13 is smaller, so this is our last big chapter, which is why it's the last part that's on the test. 13 is just ratios and horizontal analysis, so it's a lot smaller. So stockholders' equity is dealing just with that last part of the balance sheet, the one section we haven't talked about. We've talked about assets, we've talked about liabilities, we've talked about all the things that go into assets, we've talked about how to come up with depreciation, we've talked about how to come up with inventory. This is the last section. All right, under stockholders' equity is retained earnings and is common stock. And we've done everything but common stock and dividends, which is dividends come from common stock and preferred stock. So when we're looking at how a company is financed, you can borrow money, which is liabilities, which we just did, or you can sell stock. The major advantage of selling stock is that it's very simple. All right, nowadays, every one of you guys can either log on the computer or get your phone and buy a share of stock within the next 10 minutes. Much faster if you've already bought a share of stock before because you have an account. But you could all set up an account in less than 10 minutes. All right? You could all buy a share of stock for under $10. And it's all that easy because of things like E-Trade and some other ones that I'm not going to think of their name right now. All right? You could all do that if you wanted to. It's easy to transfer ownership because you can do it just like that. You no longer have to call Edward Jones or Merrill Lynch or have a stockbroker. You can be your own stockbroker. Unfortunately, that doesn't mean you're going to be good at it, right? That means that you're going to do what you want to do and not necessarily go and get advice. Now, that doesn't mean you won't be good at it. Some people are better at managing their own stock than going through somebody. And then the third thing is there's limited liability. What do I mean by that? What is limited liability?
You don't have to pay them back.
We don't have to pay them back. What is the most I can lose if I invest in a stock? What I invest, right. So when Enron went bankrupt, that was the company we talked about with Sarbanes-Oxley, what did people lose?
Their retirement amount.
Yeah, unfortunately, a lot of them lost a lot, but that was because of how Enron before was set up. So if you went out and bought 3 shares of AT&T trading at, let's just round up, $40, how much money would you lose if AT&T went bankrupt tomorrow? 3 shares of stock trading at $40, you would lose $120, right? And that's it. If AT&T got sued tomorrow and you own their stock, would you be in trouble? No. That's why people like the stock market, because they don't get affected except for the fact that their stock price. And I think, Maria, you said, why does the stock market get affected? Well, when a company does bad things, and I used BP oil when I talked about contingent liabilities, what do you think happened to BP's stock when they had the oil spill? It went down a lot, right? Did it rebound? Yes, they're fine, okay? But they're fine because they took care of their spill. And they backed it up. They sent a lot of people down there. They took care of the animals. You know, they did a lot of things. From my little understanding about what they did, it's my understanding that they took care of things. So their stock went back up. All right? Companies that take care of things usually can recover. Yes?
How do investors receive money back if the company doesn't give dividends?
Okay.
Like they just get the money back once they sell the
Exactly.
stock?
So a stock like Google, so when I got my master's, which was 11 years ago, Google was trading at around $300 a share. And I think I mentioned this already, but between your class and the other class, I get confused. It was trading at $300 a share. And the question that was posed to us was, will it go higher? And my answer was no way. Okay, but my answer was no way because what did you guys notice when you all put your stock on the board? What was the one common theme with most of your stock? What was the price? It was somewhere between $10, even though one of you guys had a really cheap stock. Can't remember who it was. But $10 to like $150, right? With one outlier or 2 outliers that were a little bit higher, and those were tech stocks like Google. So I'm like, no. And even back then, Google at $300 was high. So a couple of you guys that had the $200 and some stock, That wasn't $200 some then. It was like $100. I'm like, it can't go higher. Well, one person in our class invested 3 shares of Google stock at $300 and 6 months later sold it at $350. 11 years later, Google's $1,200, $1,400, $1,200. So obviously I was wrong. Okay. How do you get that money? By selling the stock. That's the only way. But when you have a stock that is continually going up in price, you don't have to pay dividends. It's a growth stock. You don't. You could. They could sell dividend or give dividends. But when your stock is like that and people are buying it without dividends, they're not going to pay dividends. What we call as mature stocks, they tend to pay dividends because that's how they get people to buy their stock. So utility companies are very known for giving dividends because they're not high. They're usually somewhere between $30 and $100. And to get people to invest in them, they are dividends.
Is it hard to sell a stock?
It depends on what stock, but no. I mean, you can usually just say, get rid of my stock, and it's gone.
Would you prefer to buy a stock by itself, like regularly, or from a company that provides dividends?
It depends on what you're trying to do. I mean, usually the best thing to do is diversify. You want both. And it also depends on your age. The longer you are from retirement, the more aggressive your portfolio should be because you have time to have ups and downs. So mine is kind of in the middle because I got time, but I don't have near as much time as you guys do. All right? And then my parents are not aggressive at all. They're very much in dividend because they are taking from their retirement as it's actually being in retirement. So they're getting dividends and they're living off dividend checks as well as having investments. So it just depends on what stage you are in. Right now, you guys would want a good, very high portion in stock that is going to be more risky. You don't want to put it all in there because that's not good, but the majority of it. I'm not the right person to talk to about that. So stockholders, what do we get a benefit? Well, you get to vote. Every stockholder. You can own 1 share of Google, 1 share of AT&T, and you get to vote. This is not your normal vote, like you just voted, hopefully, most of you voted. In that I would tell you your vote definitely does matter. I can honestly say I haven't voted a lot for my stock. All right. Most of the time I don't know what's going on. But depending on what it has been for AT&T, I have voted. So it just depends on what comes out. You get to vote. You get dividends if they pay it. You get what's called residual claims. That's what's left in the event that the company is, like Enron, falling apart. But when you own 400 shares out of, 540 million shares or whatever they happen to have out there, you're not going to be at the list of that. And then preemptive rights. So why do we have equity? Stock, first of all, doesn't have to be repaid. It's the best thing about stock. You issue it, you get cash. Number one reason, and the only reason you sell stock is because you get cash. And dividends are optional. Google pays them, AT&T doesn't. So the other column right there is what disadvantages or advantages of debt. So if equity doesn't have to be repaid, why would you do debt? What's an advantage of debt financing? There is one, I promise. If stock is the perfect world and you just get cash, you never have to pay it back, why would you do debt? Why would you borrow money if stock is perfect? What'd you say?
Interest.
Interest. And what is interest?
The ability to pay more, I guess.
It's ability to what?
To gain more money.
Well, we pay interest. But that's a good thing. You're on the right path. If we pay interest, what is good about paying interest?
Credit,
Huh?
your credit
No.
is higher.
No, not credit.
Paying interest is good.
It can be good. Why? It happens around April 15th every year.
Oh.
All right? Interest is tax deductible. Interest decreases your net income, which makes you pay lower taxes. That's a good thing. Remember LIFO? One of the reasons people use LIFO as inventory method is because you pay less in income tax. There's another one. What is, it's an advantage to borrowing money, but it's also a disadvantage of equity. What happens every time you sell a share of stock? How many people know that Anheuser-Busch was bought out by InBev? It happened like 5 years, 6 years ago. Okay, thank you. You guys are young. All right. When Anheuser-Busch was bought out by InBev, a lot of people that were old enough to realize it were shocked that the Bush family didn't own more stock than they did. Because over the years, they had sold their stock and sold their stock. Everyone just kind of, no, I shouldn't say everyone, a lot of people just kind of had this assumption that they owned the majority of the stock because they were the Bush family, right? The Bush family would own the stock. They had something like 7% of the stock. That was it. Because over the years, they had sold their stock. What happens when you sell your stock? Other people slowly get what?
Control it, no?
Control and ownership of the company. So another disadvantage is every time you sell stock, you lose a share of your company. You lose ownership. Yes, every time you sell a share of stock, you lose ownership in your company. Every single time. So that's not a bad thing, but it's not a good thing. Google, it's my understanding, the two Google guys still retain 51%. So it's not even just the majority, they retain 51%. And that's a big deal. That means no one can take them over. Now, some companies, you can still have the majority share and be at 7%. That just means no one owns more than 7%. But I don't know how much Warren Buffett owned of Anheuser-Busch, but he owned a lot. And he was a big shareholder of AB. And because a lot of people looked to him to decide what should we do. Because AB was a big American brewing company. So to have this foreign company come in and buy our beer, that was not what people looked upon. In St. Louis, it stayed Budweiser. And in the other states, it stayed Budweiser. But if you work for AB, it's not the same company. Okay? It's AB InBev. So the stock has changed every time. You got to know those. Advantage, you get cash immediately. Disadvantages, you lose control of your company slowly. Now, you don't have to lose control. I shouldn't say that way. You lose ownership. You could lose control. So one of the things we want to look at is, with stockholders' equity, we have contributed capital, we have retained earnings, something called treasury stock, and then we have other comprehensive loss and gain. Treasury stock, we've talked about it one time. Anybody remember what it is?
The company buy it, yeah.
Exactly. It's when the company buys back their own stock. Company buys back their own stock. All right, so let's take a look at a company buying back their own stock and stock transactions. So when a company decides they want to sell stock on the stock exchange, they have to go to the SEC, Security and Exchange Commission, and they have to ask to sell stock. You can't just decide to sell stock publicly without that. You can be a privately held company and sell stock, but then you're not on the NASDAQ, you're not on the Dow Jones, you're not public. So you go to the SEC and you ask to sell X amount of shares. So if I ask to sell 1 million shares, that is how many shares I am authorized to sell. Now you can go back if you sell those, and you'll have another classification of stock. So this is the total amount I can sell. I cannot sell more, and it's not a dollar sign, I don't know why I do that, than 1 million shares. All right? Then I have issued and non-issued. Right? Issued is the number of shares on the market, or I'm sorry, the number of shares sold, and this is the non-issued is the number of shares not sold. Pretty self-explanatory, hopefully. So non-issued plus issued equals authorized. So if I have 600,000 shares here, I would have 400,000 shares there, which would equal 1 million shares. These have not been sold. They are not owned by the company. The company did not buy them. They are just sitting there waiting to be sold. Right. Then off issued, I have 2, which if you add together equal issued. I have what's called outstanding and treasury stock. Outstanding is on the market, and we're going to say 500,000, and treasury stock is 100. Treasury stock is bought back and owned by the company. So authorized, total amount that a company can sell. Issued and non-issued. Issued is the number of shares sold. Unissued or non-issued, never been distributed to anybody.
So, the example that you gave for the AB company, the 70% that they own is treasury or is
The amount that AB would own in my example is only this 100,000.
that would be treasury?
That'd be treasury, yep. And that would be outstanding plus treasury would equal your issued. The unissued is owned by nobody. It is not owned by the company. The company has not bought it. The company could buy it, but the company has not bought it. And we're going to talk about why a company would buy its own stock in a second. All right, so outstanding owned by stockholders, treasury is shares that have been reacquired by the corporation. So it's really important that you know the difference, because outstanding is who gets dividends and who votes. Treasury stock, you cannot buy your own stock back so you pay yourself dividends or you get to vote. All right, treasury stock does not get dividends, treasury stock does not get to vote. You cannot buy your own stock back so you can influence decisions on the voting. That would be illegal. All right. So you pay dividends and vote on outstanding shares, not on issued. There are some very simple questions, and there has been a very simple test question that is missed by a lot of people because you don't read the question on issued and outstanding. So you want to make sure you remember this slide or what I wrote on the board, whichever way you want to remember it. All right, issued, outstanding, treasury. This is an example of how the balance sheet looks. Now you guys should have seen this doing your annual report. It looks a little bit different because we have preferred stock, which you guys have not seen. We will talk about preferred stock on Tuesday. All right. Here's your common stock. There was a little bit more information in Home Depot's. This is a little abbreviated because it would be overwhelming on the slide, where Home Depot actually had the 2016, 2017 beginning and ending shares. This just tells you that you were authorized to sell 75 million and you had issued 50. You would not be able to do an average on this information. Notice it talks, I'm going to talk about this number right here on the next slide, par. Then notice here it said 506 million, 504 million, and then down here we talk about something called additional paid in capital. I'm going to talk about those two numbers next. So what is that par value? Par value is a nominal, made up, arbitrary number. It is literally made up. It does not equal market. They are not the same thing. It does not equal the market price. It does not equal the stock price. It is a made-up number. Sometimes it's a penny, sometimes it's $1, sometimes it's $10. It is a very small number. All right, so if you look at what this number was, it was I can't read that. Is it a penny or a dollar? Okay, it's 0.01. Thank you. All right, and that's what it is. If you look at the preferred stock, it was $1. So it's a very small number. All right, it does not equal the market price or what the stock would sell for. There are some states that do not have par. If that's the case, you'd use the stock price. And then real quick before we get to the journal entry, the one time a company makes the most money is something called an IPO. It's the initial public offering. That's when the company gets the most bang for its buck, because that's when they take these authorized shares and they put them on the market for the first time. That first offering is when they get the most attention. Because once the stock's on the market, if Kalanda goes out today and says, I'm going to buy a share of Barrett Corporation, but I went public 2 weeks ago, is he buying from me, or could he possibly be buying Michela's stock if she's selling hers? I don't know, right? It depends on how he buys. If he just goes out to the app on his phone, does he know where he's buying it from?
From you?
No, he doesn't know. All he knows possibly is he's buying a share of my stock. If he goes through an investment broker, they might go directly to me, or they could be buying from her. Once it's out on the open market, it could be bought from any one of you or me. So the most bang for the buck is going to be the IPO. And that's when a company has to make their big bang. They've got to come out. So companies really have to think about when they go public. When is the timing? Have they gotten out the information? Is this the time to go? Is the market right for them to go public? Because that's when they're going to make the most money. The only reason a company goes public is to make money. Because as soon as they sell one share of stock, what did they lose?
The ownership.
Ownership. My brother's company's been talking about going public or selling to go public for probably 10 years. They just haven't found the right buyer, or they haven't decided it's the right time to do it. Got to make sure you got that right time. So let's look at some journal entries. All right, so I issued 100,000 shares of $1 par stock for $20. So the first thing I want you to ask yourself is, why do I sell stock?
You need money?
All right. So the number one thing I do is for cash. So what am I going to debit?
Cash.
Cash. How much cash am I going to get? I know I haven't shown you any. I just want you to think about it. How many shares did I buy?
20.
No, how many shares?
100,000 shares.
100,000 shares. What was the stock price?
20.
$20. So if I sold 100,000 shares at $20, that is $2 million?
Yeah.
Okay, thank you. All right, $2 million. What am I going to credit?
Your ownership.
Well, yeah, and what do I call it? What am I selling?
Common stock.
Common stock. I sold 100,000 shares. What price?
20.
2 million.
No.
No.
You are going to credit stock at the par value. And 100,000 times 1 penny is actually 1,000. And the rest is going to go in this wonderful account called additional paid-in capital, which will be 1,199,000. The reason is this. What is the stock price going to be tomorrow?
You don't know.
We don't know. Or the next day? We don't know. If I were to put $2 million in common stock and the stock price fell to $17 tomorrow, isn't the common stock account going to be overstated? So therefore, my financial statements will be inaccurate. Is that correct? Yes. So I can't put common stock, an account that is a permanent account, at a value that is inaccurate, that is going to actually change daily. In addition, common stock represents ownership in my company, correct? Is that really a dollar amount? No. So what they've determined is that arbitrary number we give par, that is what we're going to put in common stock. Some low dollar amount, 1,000, that is way below the value of the stock, And then the rest of it is going to go to this account, APIC, additional paid in capital, which means funds coming into the company, which is exactly what it is, correct? Additional funds coming into the company. APIC, which I abbreviated, is abbreviated the same way for companies. I'm just not, a lot of my abbreviations I make up. That one's not. They actually call it APIC. Additional paid in capital is the amount of money made in excess of par. It can go up and it can go down. I'll show you examples of it going down Tuesday. Probably not today.
So
But go ahead.
if you didn't have the par value, do you have to
Then it all goes to
adjust-
common stock.
Do you have to adjust it every
Nope.
time?
Nope. It just all goes to common stock, and it can be a large amount. Think of how much common stock could be every time you made a journal entry if you don't have par. And then think about what your balance sheet would look like. Yeah, that's why we use par.
So the par value is the ownership.
Par, no. You don't, the reason we use par is because we don't really want to track ownership. We track ownership by the number of shares, not a dollar amount. You really can't put a dollar amount on ownership. You're looking at as the number of shares. The number of shares represent the ownership. Okay, we already talked about this. Yes.
So what's the difference between par value, per share, and per share?
Okay, I don't. Par and per share.
Can you back to the slide?
Okay, $20 per share is the market price. That's how much cash we're going to get. So the this price here, this is the market value, and so when we sell it, that's how much cash we're going to get. Par value is just an arbitrary number assigned to the stock, and that's what's going to go in the common stock account. So common stock is going to increase by the par, cash is going to increase by the market price.
It's a value for per share.
Is the what?
Value for per share or 1 share.
1 share. Yep. And we talked a little bit about this. When Kalanda sells to Michela, does that affect my stock and my company?
Nope.
No. The only thing it does is whenever that stock is selling in general, that's a good thing. But it doesn't affect me directly. So why does a company buy its own stock back?
To regain ownership.
To recover all
To regain some ownership, but why?
because they want to take their own decisions.
Because why?
They want to take their own decisions.
Well, no, they don't get to, they have no voting.
They will sell it with higher prices. Again.
They hope to. That would be a good thing. Okay? So there's a lot of different reasons. One of them is to compensate employees. All right? Now, there's a lot of different reasons. One of them is it can be included in your employee pay package. A lot of times that's upper level pay, but it can be included in pay packages. It could also be something called an employee stock option, or it could be awarded as like a pay. Like you get to this goal and we'll give you options. Options are wonderful. When I worked at AT&T, that's how I got a lot of my stock. Some of it was if the employees as a group reached this level, then everybody got a stock. You were awarded stock. So that was just 40 shares or 10 shares or whatever if the group hit this number. The stock option was if the company as a whole hit this, then you had the ability to buy options. Buying options is something like, as of today, every company or every employee has the ability to buy so many shares of stock at the price of $42 a share starting July 1st. So I can't do it now, but the price is $42 a share right now, and in July 1st, I can buy it at $42. I have 3 years of which I can buy it. Okay, well, that's great. It's not till July. Well, July comes around, and the stock's selling at $45. So I can buy it and make $3 per share, or I can wait. And then I have to decide, because in 6 months or a year, it could be selling at 40, and now I lost money, or it could be selling higher. Well, that actually happened before I got married, a couple years before I got married, and I held on to the stock, and about 6 weeks before I got married, the stock hit 70. So I had 40 shares that I bought at 42 and sold at 70. So I made $28 a share.
You immediately get that money.
I immediately got that money because AT&T set something up with Merrill Lynch to help you buy and sell immediately. And so that was a great stock option. But then there were other stock options, we had almost kind of the same deal, different price, but by the time that the 6-month holding period went, the stock was lower. So the options were worthless. So it can be fantastic, and it could also backfire. It just depends on the market. And then you can, you could get a high profit or you could not get one. The other reason a company might buy their own stock back is signaling to everybody else that they think their company's doing good, which is kind of what Maria said. I'm going to buy my own stock because I think I'm going to buy it and be able to sell it for a profit later. Why would I buy my own stock if I think the price is going to go down? All right? You might do it to buy another company. When InBev bought AB, and when my company Mallinckrodt got bought out by Tyco, in order to go through with that buyout, you have to replace the other company's stock. So when Mallinckrodt got bought out by Tyco, for every share of Mallinckrodt stock that I had, I got 3 shares of Tyco. Well, the only way Tyco can do that is that Tyco has to have enough of its own stock to replace all of Mallinckrodt's stock. The only way you do that is by buying your own stock back. And then stock options, which I said, and then to reduce outstanding shares to increase per share measure of earnings. So if you want to get your earnings per share up, then you got to reduce the number of shares outstanding. So they do that. So sometimes it's kind of to manipulate some ratios. So treasury stock, again, just another graphic. I already mentioned you get no voting rights. So when you buy your own stock back, it's a very straightforward journal entry. It goes in at the cost that you buy it. So if I bought 50,000 shares at 25 bucks, that's exactly the cost I put it at. So it's 1.25 million. It's how much I cost. It goes into treasury stock. I have 50,000 shares of stock. Now this is where it gets a little fun. The next slide says I sold 28. I'm sorry, I sold 5,000 at 28. All right, if I sold 5,000 shares of stock at $28, what do you think happens? First of all, what do you get when you sell stock? Cash. The reason I ask it like that every time is I expect nobody to miss the debit when you're doing journal entries for selling stock. So how much cash did I get? I sold 5,000 shares at what price?
28.
So you always do it at the price it tells you.
That's 140.
Thank you. 140,000. Then I have to take it out of treasury stock. Do I do 5,000 times 28? No. What do I do it at? 25.
Why
Be-
25?
Because that's what I put it in at. If you look at my T account for treasury stock, I have 1.25 million in there. If I take some of it out at $28, I'm eventually going to run out of dollar amount. You take it out at the price you put it in. So what's the additional 15 bucks? Maria told us this. We made money. Additional paid in capital, that same amount. We made money on the stock we bought. We bought our own stock back, and then we turned around and sold it and made money.
What's the treasury stock?
Treasury stock is when a company buys its own stock back.
From another company?
No, from out on the market. So it's not a profit or loss, it's a gain. It's additional paid in capital. Now, the example's not in here, but what would happen if I sold the stock back at $20? Would I still debit cash? I sold treasury stock back at 20 bucks.
Yes.
Yes, all right. So I still would have cash, 5,000 times 20 which would be 100,000, I would still have treasury stock at
25.
25.
So you lost money?
But exactly. This time,
So you deduct it from,
I would deduct it from APIC. I lost money. So you can debit APIC, you can debit APIC. You don't want to, but do you think a company can buy back its own stock and turn around and lose money? Absolutely. The market goes like this, everybody. That's the biggest thing you got to remember about the stock market. It goes up and down. You will lose money. You and I will lose money. Companies lose money. It's just how it goes. If companies never lost money, then that company is doing something fantastic. And they probably would be investigated by the SEC. Okay, so that's just what happens. Which takes us to this, which we'll talk about Tuesday, but hang on, and preferred stock. I highly recommend that besides doing your Chapter 10 homework, that you really at least look at the videos or do start the homework, because Chapter 11's on your test. So if you don't at least start the homework or look at the videos, you're not giving yourself time to ask questions about stock or to look at the dividends, because we will also be starting preferred stock, which preferred stock's not hard, but we will get all the way through the dividends, which isn't a lot, and then do preferred stock. There goes my people. What was I going to say? So your test, just to make sure that we're on the same page. You want it the same format?
yeah, that's cool.
Okay. That's easy. All right.
You have a full page again?
Yes, you have a full page, one side only of notes. Okay. I also would highly suggest that maybe you do a little better job